Okay, so 6 mark questions. You need to be aware of the benefits and limitations of different methods. So some of those is verification methods. And a lot of students get confused when I say verification methods. All we're talking about is the techniques you use to check if errors have occurred. So there's 3 main ones on the specs. That's your trial balance, your control accounts, and your bank reconciliation. And so sometimes if you've got the numerical question, you might have a 6 marker link to them, which could be um, Dave thinks that a trial balance is a waste of time. Do you agree with him? Or Dave thinks that the bank reconciliation will find all errors. Do you agree with them? Whatever it might be. I don't know why it needs to be Dave, but apparently it does today. And so what you need to be aware of is the benefits and drawbacks of different methods. So if you look at the trial balance, the key argument for using trial balance is that it does reveal certain double entry errors. Now I call those 2-back errors, but transposition, unequal posting, partial omission, additional casting errors, the trial balance will find those. And so therefore, if you had a linked numerical question, you'd find an example of one of those and say, well, because of that error happening, the trial balance would not agree, the debit and credit totals would not be the same. So therefore, that shows why it's useful. The other reason why the trial balance is useful is because it gives you all the figures that you need to prepare the financial statements. You've got those figures to work out for the SFP and for the income statement. However, if you're going to balance it and say, well, the trial balance isn't fully accurate, you would look at the fact that certain areas aren't covered, so what I would call the PROCOC errors. So principal error, reversal of entries, omission, commission, original entry, and compensating. None of those are actually identified by the trial balance because the debit and credit have been posted the same. So therefore, I wouldn't find it. It also doesn't show where the error occurred. It's just a crude instrument, isn't it? Just the 2 figures are different. So you open up a suspense account and you need to fix it. So if you were looking at the pros and cons of trial balance, that's what you'd look for. Bank reconciliation, so the item that I think is going to come up this year. And so if you were reviewing the benefits and drawbacks of those, so the good thing about bank reconciliation is you can find items that can be updated in the cash book, such as bank charges, dishonored checks, or transactions you just weren't aware of, like a direct debit. Also helps to prevent fraud because if money's gone out of the account and you weren't aware of it, so you would see it on the bank statement when you're reconciling it, and that can help you to investigate it. It can also help you to identify a stale check. So a stale check is one that you've written that's now out of date. So a check usually lasts for 6 months. And so if you are double checking your bank reconciliation, you can see that's not gone through. You can identify it as stale and then update your records appropriately. And I'd referenced a dishonored check before. So dishonored check, so a check that a customer has given you that has not cleared their bank account. So therefore you would find out when you get your bank statements and you would update your records again. However, bank reconciliation, there are timing differences. So sometimes it's difficult to find errors because it's just the fact that money is being in and out so quickly. So it's not always easy to spot. And it doesn't spot all of the mistakes that you can make. The one good thing with bank reconciliation is it is one method that can find an omission error. So if you've not included a transaction in your records for a payment that's been received or made, you'll find it on the bank rec because that money is going to go in and out of your account and you would suddenly be able to adjust for it. If we look at the control accounts, there's 2 control accounts, trade receivables ledger control account or sales ledger control account, and trade payables ledger control account or the purchase ledger control account. So basically what that does is the control account is like a testing measure. On the specification, the control accounts are what we call memorandum entries, so not part of the double entry, they're just a test. So you've got, if it was the purchase ledger, you've got your list of all your suppliers in the purchase ledger, they get posted to. So all the payments, all the discounts, all the purchases, all the returns, whatever it might be, goes into the individual accounts, and then the totals get posted to the control account. And so what we can then do, and we do the same with receivables to sales ledger account, we can see some addition errors because if you've balanced off either the control account or the individual accounts incorrectly, they won't agree. And then you can look into the fact of what mistake has happened. As a result of that, the total will give you your trade receivables and your trade payables balance that you can use the SFP rather than the list of individual balances because you wouldn't include those in your financial statements. You just put one overall value. Prevents fraud. So what we've got here is a segregation of duties. So the control account in a business would normally be completed by someone more senior, and then the individual records will be completed by the purchase or sales ledger clerk. So you've got that segregation of duties, that separation of who completes which task. So if there was some fraudulent activity, the person completing the control account would spot the differences and investigate. However, control account again can spot all the different errors that occur. So a commission error is where you put it to the wrong account. So if you charged Dave instead of Clive, the balances would still agree, so we wouldn't spot that. So you'd have to find that in a different way. If you didn't include a transaction at all, well, it wouldn't be on the control account and it wouldn't be on the individual accounts. It still wouldn't balance. And just like with the reconciliations, instead of state where the errors occurred, you just got to go, oh, they're out by a certain amount, and you just kind of hope that you can spot them. And in an exam question, quite often it would be straightforward. So bank reconciliations, good shout, going up. Control accounts linked to sales and purchase ledger not come up, so it could do. But it wouldn't be a massive question, I've got to be honest. But you could have the list of supplier balances, add them up, compare them to purchase ledger control. Why are they different? But yeah, you need to know the pros and cons, and I hope that's given you a good idea of what they are. Okay, cheers.